I want to tell you how much I paid for my own home, how much it's worth now, and how I manage the equity in it. I'm really going to open it up for you today. Hi, I'm Keith Weinhold. This is Get Rich Education. Over 8 years ago, I was interested in buying another home in Anchorage, AK, and the home that I was interested in buying had an asking price of $470,000. So I was thinking about how I could approach this. Now, I did have enough for a 20% down payment, but I know that it's wise to keep equity separated from your home. What's the best way to keep equity separated from your home? It's to make sure that it never goes inside the home in the first place. So here's how I played it. Here's what I did. I put just a 5% down payment on the home, borrowed 95%, and did not have any PMI payment either. Typically, when you put less than 20% down on your primary residence, you have to pay what's called PMI, private mortgage insurance. It's basically an annoying premium of a few $100s a month that you actually have to pay the bank to protect them, and that they can pay their insurance against you defaulting, because those with small down payments have little skin in the game and they have more of an incentive to walk away. All right, so here's what I did when I bought the home. I offered the seller their full asking price of $470K, making them pretty happy on that end. And then I said, however, I would like $12,000 refunded to me at the closing table. $7,000 of those $12,000 I used to pay an upfront PMI premium. That way there was no monthly PMI that I had to pay going forward, and I was able to put just a 5% down payment on the property and borrow more, keep equity out of the home. And yes, I want to borrow more and leverage against that at these low mortgage interest rates, much like we had more than 8 years ago, and of course they're even lower now. So that's what you do to keep equity out of your home in the first place. And I don't mind getting personal here with you on a video like this if it's going to help you, because I think that you're really going to find it insightful. So I'll tell you what my home is worth now, and then I'll tell you why I'm going to strip the equity out of it. Hey, put a YouTube like on this video if you would. You know, that tells me it's a good video and that you do like more videos like this where I personalize it and really give you real life numbers and how I'm doing what I'm saying and saying what I'm doing. I would love the YouTube like. And yeah, to look at another shot or two of this home in this city of 300,000 people that I live in, though it feels very much like suburbia. It's a ranch home. It's on a quarter-acre lot. And you know what? I enjoy the premises. You know, we're playing cornhole and we're playing croquet in the yard, regardless of one's equity position. Yes, we're playing yard games on a highly leveraged piece of real estate. Now, I want to borrow more when rates are low, and my favorite loan for primary residences has been that 30-year fixed amortizing loan, that plain vanilla loan. And my mortgage balance today is $360,000 just through regular principal pay down, through regular amortization. Of course, I have never made an extra principal payment, not even $1. If you've been watching me for quite a while, you remember from my previous videos that if you make an extra, say, $1,000 mortgage principal payment to the bank, here's what you're telling the bank. Hey, Mr. Banker, here's an extra $1,000 mortgage principal payment. Don't pay me any interest on it. If I need it back, I'll pay you fees, and I'll prove to you that I qualify again. That doesn't make any sense. Home equity is unsafe, it's illiquid, and its rate of return is always zero. So I don't want that to accumulate in my property, and it's been accumulating. So the home is worth about $550K today. I just looked at that today. I probably haven't looked at that for 1 to 2 years. So yeah, there has been some appreciation, but not really that much overall. So let's look at this. With my mortgage balance of $360K, that's how much I owe the bank on the property, and a property value of $550K. All right, well, that's 35% equity that I now have in the property and 65% debt. Another way to say that is that's $190K of equity and $360K of debt. And if I can, I want to reduce each dollar of equity. And for each dollar I reduce that, I want to build up another dollar of smart debt. We can look at this in a few ways. Inflation debases your equity and your debt at the same rate. Okay, so in this case, with that 190K of equity at a 5% inflation rate, which is about what we've seen lately, my equity therefore is debasing my wealth at $9,500 a year due to that 5% inflation on the 190K of equity. Well, debasing my equity is generally a bad thing. And at the same time, with the 360K in debt that I have, inflation's debasing my debt by $18,000, 5% of that 360K, because of course, down the road, inflation helps me out when I'm a debtor because the bank does not ask to be repaid with inflation-adjusted dollars, only nominal dollars, and throughout time, wages and salaries and prices rise. Remember, just the other day, Robert Kiyosaki was here with me, and he talked about how money really is debt.
The dollar became what's called fiat currency, or what I call fake money. More specifically, it became debt and taxes.
This is part of what he and I were talking about right here. And before we look at some more numbers, you can get a better than average home in Anchorage for $550K. Yeah, you do have a higher cost of living for housing and some other things compared to where I grew up in upstate Pennsylvania, but the cost of housing in Anchorage isn't nearly as high as it is in New York City or Southern California or even Boston. But yeah, you can get an above average home today for $550. So should I do a cash out refinance? That's really the question. Should I refinance at a lower interest rate and extract cash at the same time? Let's see how that would look. So I told you that I got a 95% loan on a $470K purchase price back when I bought the property more than 8 years ago. So my original loan amount was $446,500. I got a 3.5% interest rate. So let's look at the principal and interest payment. That's almost exactly $2,000 in monthly principal and interest that's being paid. Like I said, it's a 30-year loan. So I can typically take out an 80% loan-to-value loan, meaning I need to keep 20% equity in the property. So therefore, I could take out a loan of $440K. That's 80% of today's property value. And I could probably get an interest rate at 3% or better. Let's just be conservative and say I could get a 3% interest rate. That's a principal and interest payment of only $1,850, saving me $150 in cash flow each month. It's still going to be a 30-year loan, most likely. All right, well, what that's going to do is that's going to free up $80K of cash for me, because with this $440K loan, we'd have to pay off the existing $360K loan balance, leaving me with about $80K that I could get for a cash out refinance. There's a few other things to consider. There would be some closing costs associated with this loan. And you got to remember, when you refinance like this, you do reset that clock. So my loan amortization schedule would start all over again. Currently, with my principal and interest payment, now that I'm this far in the current amortization schedule, about half of my payment goes to principal and half goes to interest. If I refinance it, my monthly payment will have about 40% going to principal and 60% going to interest. Not a big difference. As interest rates get lower, even from payment number one, with those lower interest rates, you pay an ever greater proportion of your very first payment of principal rather than interest. This is a relatively small consideration though, because it's really about the cash flow of the property. Just a little thing there. Hey, put a YouTube like on this if you haven't yet. Besides telling me it's a good video, it also tells YouTube that it's a good video, and it might show it to more people and help more people. So I'd really appreciate the YouTube like. You don't have to, but I'd love it. All right, so this looks like an advantageous thing for me to do the cash out refinance. What I'm doing is stripping equity, also known as harvesting equity. Because home equity is unsafe, illiquid, and its rate of return is always zero, kind of like crops that get old in the field if you leave them there until the winter time and rot. I want to harvest that equity and actually help me use it to generate a return somewhere else. So what I like to do when equity accumulates, my favorite thing to do with the investment, although it's always good to keep some liquidity, is to go ahead and use that to make a down payment on more income property and expand my portfolio that way with, yes, equity that's built up through leverage in my primary residence. And understand that when I do this, no equity is lost, equity is merely transferred. Additionally, I've lowered my risk in a number of different ways. I've already explained some of them, but the other thing that I've done is now that I'm transferring equity, I'm actually able to move that equity from one market and into a second geographic market. In real estate investing, the market is more important than the property. So I'm actually reducing my risk by being in multiple markets, hedging myself against economic downturns in any one market. So that's why I like to do this. I mean, my goodness, if I can borrow against my home at 3%, and then get a rate of return of 20 to 25% in an investor advantage real estate market, I want to do more of that. That's how financial freedom is created. And if that's a new paradigm to you, if you're uninitiated on that, you're typically paid up to 5 ways at the same time with rental property. That's why a total rate of return of anything less than 20 to 25% per year is actually disappointing. When you add up appreciation, cash flow, your return on amortization, your tax benefits, and then the inflation profiting benefit that you get on long-term fixed interest rate debt. That's how you generate a high return on investor advantaged income property. It could get even better than this. I, first of all, don't want to pay off my home. I want to keep borrowing against it. What I want to do is build up residual income streams. It could get better because as I go into the primary residence lending landscape again here for a refinance, maybe I can get a 40-year loan now. They're becoming just a little more prevalent. They're still somewhat rare, but that might be more of an option. And I always want to look into an interest-only mortgage as well because that automatically increases my cash flow. I would rather have cash rather than put $1 of equity into an amortizing loan if I don't have to. Remember, even if you pay off your mortgage, you still would have a housing payment anyway because you're still going to have monthly payments for property tax and property insurance and maintenance and repairs and utilities and more. There's no escaping a housing payment in your life, not at all. Now, should you be renting or owning your home at all? I don't know. I can tell you one thing, that in your own primary residence, paying rent is not the same as throwing money away. In fact, I recently made a video called Should You Rent or Own Your Home up here. Oftentimes, it makes more sense to rent your home than own it strictly from a financial perspective. Let's look at my own home that I live in. How much would it rent for versus its purchase price? Well, it would get about $2,700 in rent. And I said that the current market value is about $550K. That yields a 0.49% rent to value ratio. All right, so that's really not advantageous as a rental. If I moved out of my own home and rented it out to somebody else, that's not a very good ratio. I've told you before, you want at least 0.7% in a rent to value ratio or better, something like that. So I typically need to go out of market, like most Americans probably do, into the Midwest and South to buy property where the numbers really make sense. Now, I may very well be better off, strictly from a financial standpoint, paying $2,700 rent in my own home instead of having principal and interest, taxes and insurance and maintenance and repairs and utilities and all that myself. But I choose to own my home just because I don't want to have a landlord that can tell me I need to move in 30 or 60 days. That would be too disruptive. So actually owning my primary residence from a strict financial standpoint, it's not a good investment. A lot like a vacation that you might take is actually not a good strict financial investment. When you did your last Caribbean cruise, it wasn't a great financial investment. It was a lifestyle investment. A primary residence is often much the same way. So I can take my equity and go into investor advantage markets in places like Central Florida or Ohio or Tennessee or Alabama or Georgia or states like that, and I can get maybe a 0.85% rent to value ratio on income property that I buy and rent to somebody else. Yeah, I can get pretty close up to a full 1% rent to value ratio today. And see, that's a good deal for me because in proportion to a low purchase price that I get to pay, I get a lot of rent yield. So to give you an example, I might be able to buy a $200,000 new construction single family rental home that I get $1,700 in rent for. That's an example of that 0.85 ratio. That's exactly what I like to do. Gotta remember that being financially free beats being debt free. The debt free person converts cash flow into equity. You want to be financially free, meaning you get to do whatever you want to do whenever you want to do it. And you do that by doing the opposite thing. You convert your equity into cash flow, which is just what I'd be doing here. So, in a sense, did I just make my primary residence cash flow? Even though it doesn't, well, it has enhanced my cash flow because I've taken the leveraged equity and converted it into cash flowing property. That is the strategy. I truly practice what I preach. That's what I do because financially free beats debt free all day. Hey, go ahead and put a YouTube comment below if you liked what you saw here. I will try to respond to your comment as best as I can. Hopefully you found this insightful, making it really personal and showing you just exactly what my primary residence situation looks like and how I know I can improve upon it. I'm Keith Weinhold. Please leave a comment below. Thanks so much for stopping by.